Looking at the bond market, yields pulling back again, and the recent declines have helped drive stocks higher. Jared Blikre is on the floor of the New York Stock Exchange with a closer look at that trend. Jared.
Josh, it has been a hectic couple of weeks in yields land. First, we had that huge run-up in yields to 5% in the 10-year in October, and then we dropped off at the very end. And a couple of notes on the macro structure by two Wilsons. First, I'm going to go to Don Wilson at Goldman Sachs, and then I have a quote by Mike Wilson over at Morgan Stanley. First, Don Wilson, who's a little bit bullish here in risk markets, saying, as usual, we've moved a long way very quickly. And he's talking about the rates and equities. I think it may get harder to keep pushing yields a lot lower. But for equities, you probably just need to have more stability. And that's something we talk about, volatility, which, by the way, the VIX is down 8 days straight. Now, continuing with that quote, to keep the relaxation theme going, we would ideally need to see continued signs of softness in the data. And that's so that the Fed doesn't have to react to anything too hawkishly. Continuing on, that would help to cement the narrative that the Fed is likely done, keep rate volatility heading lower, and push people back towards equities. And that would be more of the same that we've gotten over the last about 8 trading days here, going back to the beginning of last week. Now, another point of view, this is Mike Wilson over at Morgan Stanley, who as usual is a bit bearish, saying last week's rally should fizzle out over the next week or so as it becomes clear that the growth picture does not support either Fed cuts or a significant acceleration in EPS growth in the near term. And just to look at the Wi-Fi Interactive here for a minute, I'm looking at a 3-month chart of the 10-year, and you can see how quickly we moved from 5% all the way down to 4.5%. Arguably, this was done in just 4 trading sessions. This one, 2, 3, and then 4. Now, if I pull up a 3-year chart, I'm going to switch this over to a line. You can see that big drop, what I just called a big drop, barely a blip. And so this is just to point out that these huge moves that we're talking about in the bond market, actually very small in the long-term picture, but because of all the leverage that's used, that makes the movements that more damaging or helpful to portfolios. And when we have bond rate volatility, that spills over into equities volatility, and it decreases the capital that's available to risk markets system-wide for all. So here's a 3-year look at the VIX, and I just want to point out we are hovering near the lows of these 3 years. And in fact, earlier this year, you can see where we just dropped to the lowest point in this time period. Is this a new regime? Hard to say, but a lot of people looking forward are looking at the term structure in equities and also the bond market, and they're looking at the expectations for all those Fed cuts next year and saying, well, maybe the market has gotten ahead of itself. So just to point out and to underscore the point that there are some very interesting differences in opinions in the bond market, and those opinions have consequences for the equities market, and that's what we're seeing hash out here. But as far as equities goes, we may get that day 8 and day 9 in the S&P 500 and the NASDAQ as far as those back-to-back streaks goes, excuse me.
Okay, Jared Blikre on the floor of the New York Stock Exchange for us. Thanks so much.